Hello and welcome back to the StoreHero podcast. Today we have a really interesting guest. We have Michael Epstein, co-founder and co-CEO at PostPilot. Michael, you're very welcome to the show.
Thanks, Thomas. Thanks for having me.
How's your week been? How's everything going?
It is always hectic, but in a good way. Growing fast, it's fun, so no complaints.
I've seen you guys all over Twitter, all over my LinkedIn the last 2 years, to be honest with you. So I've no doubt everything is taking off. Just for our listeners, I'm based in Ireland. Where are you based yourself?
I'm San Diego.
San Diego.
Yeah, Southern California.
The weather's probably a little bit better than doom and gloom here I have in the west coast of Ireland, but I won't hold it. Yeah.
I think I'd like Ireland's taxes with San Diego's weather.
Yeah, we have that one up our sleeve, all right.
Yeah, California does not.
Touchy subject. Listen, Michael, always start by kind of get people to intro themselves. Maybe start by telling us how you got into e-commerce.
Sure. I'm old. I've been in e-com for over 25 years at this point. I started a company back in 2000 and sold it in 2013 to private equity, and then got into this private equity work where I met my business partner and current and co-founder Drew. We've been private equity operating partners for a couple funds for last 10 plus years, and now we started and run PostPilot. So that's the very condensed history, but it's been a ride over the last 25 years.
Yeah, really interesting. Before we kind of dive into PostPilot, even touching on the private equity piece as it strictly kind of relates to D2C, it'd be interesting to kind of understand, like, what does that look like? What did you kind of do on a weekly or yearly basis?
Sure. So Drew and I, our calling card kind of became turnarounds, which has always been an interesting experience. Basically taking big busted 8-9 figure portfolio brands owned by the fund, and the typical profile was like 100 top line, losing 10, and basically get them profitable and growing again, and then get them sold. So that's really what our focus has been on the private equity side. So working with value-based private equity funds as partners and turning those companies around to get them profitable and sold.
And typically, because like this is such a hot topic at the moment, really strong top line revenue, but we're losing a ton on the bottom line. Is it a problem with a misunderstanding of unit economics? Is it bloated operating costs? Is it poor operating principles? Or was there a common theme that you would have seen around some of the turnarounds that you guys would have had to done quite successfully, I might add?
Yeah, it's a great question. And some of the common themes, well, one, a lot of the companies that we have worked on are on legacy tech stacks. So these are brands that have been around for some time, probably started building out their infrastructure before Shopify even existed. So it's like infrastructure wise, they're typically a mess. They've typically gotten pretty bloated operationally from a headcount perspective, and you can also imagine that those are kind of related in that if you have sort of this big bloated infrastructure, you need a lot of folks to maintain and support that. But they also typically have gotten away from sort of the fundamental principles of what drives good, sound e-commerce growth and profitability. So everything from unit economics to the team and culture. Typically, when we step into one of these situations, it actually starts with team and culture before we get into the actual execution of the business. Yes, there are certain steps that we typically need to take right out of the bat to just right size the business from to try and stop the bleeding a little bit. But it's really about, building a culture of execution, whereas a lot of these companies have really gotten not just bloated, but stagnant and bureaucratic. I'll give you a funny example with one that we worked on. It was a carve out from AutoZone, which is a large publicly traded company, and that big brick and mortar company that had been around for ages. And then this was like their in their mind this small sort of digital division that they had acquired, and people were wearing the AutoZone uniforms into the office. There was an AutoZone cheer that you had to do at the beginning of the day, and everything was super bureaucratic because it was owned in part because it was owned by this large company that was also a publicly traded company. So you can imagine finance department had gotten crazy big. There was just a lot of fundamental things sort of broken there from an operational and sort of operational perspective, as well as just the culture of the organization. So we really spent a long time just focusing on getting the right people on the bus, the wrong people off the bus, and building a different culture of transparency and execution and empowerment, even though it's kind of a cliche word. And then once you kind of have that in place, then you can start to really put your foot on the gas from an execution perspective and start leaning into more growth initiatives. But that's pretty common in terms of what we see when we typically step into one of these companies.
And typically, would your role have been to kind of try and fix bottom line? And why I kind of asked that question, I suppose, is that, everyone's looking for margin expansion in D2C today, and they're looking at it obviously from a marketing efficiency perspective, but also from an OpEx line. And, a lot of businesses I speak to on a weekly basis, they come to us and say, look, we're trying to double top line revenue next year or whatever it's going to be. And just setting that overarching top line revenue goal can lead to often perverse incentives for the people who are kind of KPI to making that happen, because, okay, we're now in November and we're nowhere near hitting our target. Let's just discount the hell out of it and push our marketing spend to the limit. You might hit that target that you might have set for the year, but you really could suck the fun out of the business, or suck the profitability, that profit capability of the business out of it. And like some of the brands that we've even worked with the last 12 months, their top line sales might have actually gone down slightly, but through some kind of consolidation of internal OpEx and better processes, top line in some cases has doubled and tripled, because that OpEx blow kind of happened over time as well. So it's such an interesting point.
Yeah, you're exactly right. And actually in the same company, give you an example of exactly what you're referring to with perverse incentives and sort of top line growth at all costs. Like when we stepped, again, it was part of a publicly traded company. And so if they had to report on that division as declining in revenue, particularly during a period of where everyone was being looked at under the microscope of like, are you growing your online division? That was very problematic from a stock price perspective. And so they were essentially propping up the revenue through irresponsible levels of spend into things that were very unprofitable. And so again, once we sort of were able to carve that out, no longer part of this publicly traded company and entity, then is very much about saying like, let's focus on the actual unit economics and fundamentals of this business and drive profitability. Because the other thing for us is there's a certain amount of working capital that's injected into the business, and when that's gone, like there's no more coming. The fund isn't just going to like keep pouring money into something indefinitely that's bleeding cash. So getting to profitability is extremely important. And I think to your point is something that we see now happening a lot too, because it used to be such that a lot of D2C brands felt we need to prop up top line growth in order to get to our next round of financing. And then we can just keep this runway, keep the runway going, because we're always going to be able to raise another round. And that was that pivot that brands had to do really suddenly. And it was very difficult, as I'm sure you've seen as well, with brands to have to pivot to a profitability model when they were really not necessarily built or operating that way from the get-go. So you're right. We've seen that a lot. Now it's really happening throughout the D2C community, and it's really important to focus on profitability. Don't just assume that you're going to raise more funds in order to keep the thing going if you don't have the right unit economics and model.
Unfortunately, the ZERP party is definitely over. So it's more important now than ever to really join those dots between the marketing and finance and operate in teams. And I think years of like really cheap CAC and ROAS and Facebook and Google probably bred terrible habits into D2C. You could run your ecom business and you have a marketing agency who are going to knock it out of the park and have responsibility for what is often the heaviest line of the entire P&L. And then you have often a finance person involved in that D2C business who doesn't understand the marketing levers. And we're not saying that accountants need to become marketers, absolutely not. And on the flip side, we're not saying marketers need to become finance people. But to grow and scale profitably today, I think both parties need to be fully aligned to at least understand the objectives of how the goals that each of them are trying to achieve mutually kind of align to the overarching goals of the business, which is ultimately to drive profit at the end of the day, you know? And I think that's such an important piece.
No, you're absolutely right. And, I don't think it would be an unfair characterization to say that, in the early days of some of these channels like Facebook, marketers could be a little bit lazy because you just had to feed, $1 into the machine and you knew that you were going to get $3 or $4 out. And it's really an arbitrage play. And now those channels are becoming much more fairly priced, essentially, because competition has entered those channels and are driving up cost. And so, it's not easy anymore. And there's David Chen, who was head of growth for like Uber and is now with Andreessen Horowitz, has this great article that I've always looked back on throughout my career called The Law of Shitty Click-Throughs, and basically says that with any new channel, competition will drive up costs over time, returns will decrease over time. And so again, it's like this arbitrage play. And to your point, you have to be, now more than ever, especially if your business has been dependent on a couple channels or a channel like Meta, you've got to be you've got to deeply understand your financials, deeply understand your unit economics, be super aligned with your finance person in your organization or your finance department, and understand like what is going to allow this business to operate profitably and continue to grow, or you could find yourself obviously in a lot of trouble pretty quickly.
Absolutely. I think that's such an important point that I just keep talking to brands about. And like a lot of brands can get intimidated by thinking that they need to become that super driven finance person, but it's like really getting down to your contribution margin level is just, it's a long way. It goes a long way. You're not just relying on, fluffy ROAS metrics from Facebook all the time that unfortunately just don't tell the full picture. Okay, so like you're 9-10 years in private equity with D2C. Why the move? Like, what attracted you about direct mail that you're like, okay, we're going to pack this in and we're actually going to go and start PostPilot?
Yeah, so direct mail was really a tool that we had used throughout our career, and particularly in some of these businesses where the largest asset that a lot of these companies had was their customer list. These are companies that had 5-10 million customers in their database, essentially, all the transactional data around them. But when you actually dug into their marketing, you'd see that they're really only reaching, in some cases, significantly less than 10%, because over time, those customers unsubscribe to your email, they just stop engaging with your email campaigns. And, we had built, we were seeing that we were really only communicating with a small portion of our existing customers. And that's typically your best audience. It's your highest value audience is people that have already done business with you, but you're not able to reach a very large portion of them. And even on the campaigns where we built out these great sort of life cycle marketing campaigns throughout digital channels like email and SMS, you still look at the open rates and you look at and the engagement. You're like, we did all this work to build out these great segments and come up with great creative and very personalized offers, and yet we're only seeing 30% of people ever even engage with that. So direct mail was like one of the tools that we would plug in very early on in the process and be like, we can get our message out to practically 100% of this audience that's bought from us before. But it was the stereotypical clunky experience of like finding a print house and exporting a bunch of spreadsheets and getting paper and then waiting 3 months for more spreadsheets to come back to try and figure out what the ROI was on the campaign. And so essentially we said somebody needs to build Klaviyo for direct mail. That was the original thesis. And so ultimately that's what we went out and did with PostPilot. And it's just sort of taken off, it's really taken off since then. And that was compounded by the fact that iOS 14 came out in 2021, made Facebook a whole lot more difficult for brands, and it started creating greater appetite and awareness around the need to diversify your marketing mix and find alternative channels that reach a higher percentage of your customers. And we're seeing that continue to persist today with cookie tracking going away and Gmail, Google updating their Gmail criteria so that it's going to make it a lot harder, starting in just a few days from now for brands to, comply with their new policies to ensure that they're getting through to the inbox. So all these things have been kind of tailwinds that make direct mail just that much more and more attractive over time.
You're probably one of the only businesses that loves to see these privacy changes coming in because it makes it feel like you're as much more appealing to everybody.
I mean, it certainly doesn't hurt. At the same time, we want to see the brand succeed. We want them to have success across multiple channels. One, because we're part of that community and we want to see these brands succeed, and two, we need them to stay around too because they're PostPilot customers, so it's important for us that they have a diversified marketing mix, a resilient business, and that includes having multiple channels that are working for them, and we just want direct mail to be one of those channels.
Nice. Makes a ton of sense. I'm only messing. How long are you guys around?
PostPilot's been around for about 4 years.
4 years.
Yeah, really, the growth has really been in the last 2. So yeah, it's just sort of around that time that iOS came out. We'd really spent a long time really developing and refining the product based on our deep understanding of the customer, and that coincided with really the time that iOS started getting more attention around again different channels, and really sort of blew up starting around then.
And how's it going since then? Obviously, you kind of mentioned the last 2 years is when it's really started to blow up. Are you largely in the US? I know you kind of recently launched in the UK as well. What other kind of countries are you operating in? Or is it largely North America centric?
Yeah, it's still mostly North America or US actually, because the cost of international postage is a lot higher, and it makes it just far less practical for us to send out of the US to international customers. Cost is a big factor. Also, time to transit time is significantly higher. So we did open up in London, and then we're going to be rolling out in Australia and Canada over the next quarter or so. And but yeah, it's just been we have 10,000 brands on the platform. It's just been it's been a wild ride.
Wow. And you mentioned that's kind of compounded massively in the last 2 years. Are you able to share numbers in where you would have been 2 years ago, or is that off the cards? How is that growth?
Not specific numbers, but I would say very exponential growth over the last couple of years. A couple of years ago it was still a handful of folks, and now we have quite a large team and quite a large customer base.
Nice. We've actually got a good few customers in Australia as well, and the sheer volume of e-com in Australia probably has taken me a little bit by surprise. So I've no doubt you guys are going to knock it out of the park down there as well. We
get a lot of requests for Australia, and we are trying to make that happen as quickly as possible, because it's definitely an active ecosystem of e-commerce brands in Australia, which is great. So how have you guys found growing the brand? I mean, I've seen you guys. I'd advise anyone listening to the podcast to follow Michael and follow Drew Sinaki on Twitter and on LinkedIn. Their content marketing is absolutely excellent. So I'd be eager to just understand how you guys have kind of went about growing PostPilot over the last couple of years. Sure. Yeah, I would say compared to like big, heavy turnarounds that are strapped for capital and growing a high growth SaaS company is more fun. Yeah. So yeah, Drew and I reflect on that and certainly don't take it for granted. But it's a lot of fun. And yeah, I mean, most of it, quite honestly, has been word of mouth and just inbound interest. As you mentioned, we're out there. Drew and I have been part of this community for, again, 25 years apiece. So we just have deep roots in the community. We have a deep understanding of that customer, and we just try and create both content and product features and capabilities that we know solve very specific pain points for our core customer. And it's really just been natural sort of organic growth as a result of that. But we, as you know, we have a partner program. We work with a lot of the top agencies and other tech partners in the ecosystem. And it's really just about getting our name out and generating awareness of like how we have reinvented this channel, what our capabilities are, because for the most part, people, still have sort of the stereotypical mindset of direct mail. Oh, it's like old and clunky and a pain, and I don't know how to do it. And I think once we get our story and out there and sort of frame it, and it's like Klaviyo for direct mail on the retention side, it's like Facebook for direct mail on the acquisition side, sort of clicks and they get it pretty quickly. So it's just it seems to be working pretty well for us.
I mean, I've seen the platform, I've seen the magic in action. Would you be able to kind of talk through our users how the onboarding works, and even like how you guys think about attribution of your product? Obviously, it's difficult because we don't have a Facebook pixel for humans, unfortunately, not yet. But it'd be interesting to kind of hear about the onboarding piece and how you kind of guys think about that attribution piece, which brands I'm sure would be really interested to hear about.
Yeah, absolutely. So we natively integrate with Shopify, Klaviyo, sort of the e-com tech stack. Makes it super simple. You add our app with one click through the App Store, same way as you would with any other app. And then you'll work with our account management team or one of our agency partners, and we'll set up, we'll propose our different audiences and different segments based on our best practices, what we know works across many thousands of brands, brands within your specific category in particular. And typically we'll create segments similar to how you would create segments in an email platform. So based on what they purchased before, how long ago they purchased, how much they've spent, things like that. And then we'll set triggers just like in automated email flow, and say for a win back campaign, as an example, you buy a 60-day supply of supplements. We want to send you a card on day 65 if you haven't come back yet. We've tried emailing you a few times. You haven't responded. We know you're at risk of defecting. So on day 65, hey, Thomas, it's time for a refill. Come on back. We'll take 10% off your cart. And because we're integrated with Shopify, we know when that customer received the card, and we know if they go on to make a subsequent purchase, and we can attribute that back to the card that they received in a real-time dashboard. And that's what you see in your campaign dashboard. So we make it super easy. Our account management team works, can build all this stuff out for you. Our agency partner can build all this stuff out for you. So it's really low lift. We know what works. We'll build out all these different segments and cohorts so that we can track each one of them independently. And we can say, how do my one-time customers perform relative to my repeat customers? How do my people who subscribe to my email list and not purchased 15 days ago perform relative to 45 days ago? We'll track each of those cohorts independently. You'll see it all on your dashboard. And we can say, great, we know that these segments are super profitable. This is who we should continue to send to or scale up. Once we hit this certain point, maybe it's no longer profitable, and we can avoid sending to those people in the future.
Nice. Really interesting. That kind of definitely clears up the attribution question. In terms of, I suppose, obviously 10,000 brands is a serious volume of data that you guys have to view. Have you seen any really clever ways brands are utilizing the platform? Like, are they sending postcards as handwritten notes to get that win back flow? Are they sending catalogs, brochures? What are people how are people utilizing direct mail?
Yeah, great question. There's a lot. So maybe I'll explain it in terms of the different stages of the funnel and the different types of products and capabilities that brands use. So on the retention side, that's again, think of it like Klaviyo for direct mail, your win back campaigns, your cross sells, your abandoned carts, things like that. Typically, brands will just use postcards for that. And because they're familiar with your brand already, they just need a bit of a nudge to remind them, okay, let me check them out again. I haven't been back in a while. And then we also have our handwritten cards, which are using our robotic tech, which literally holds a pen to paper and writes with all the nuance of human handwriting. And we'll do that for like VIP campaigns and actually birthday campaigns. So one of our newer capabilities is we can find birthdays for about 90% of your customers, even if you have never collected the birthday. And so we'll trigger a card like 2 weeks before their birthday that's like a handwritten note that's wishing them a happy birthday, maybe offering them an incentive to come buy something as like a special birthday gift from the brand. Super impactful. Customers love it. It feels like a super memorable touch point. How often do you get like a handwritten birthday card from anybody except like your parents maybe? And it works really well. So those are the types of things that brands are typically doing on the retention side. On the retargeting side, we have Mail Match, which matches email addresses to a postal address. So people who subscribe to your email list never purchase. They go through your welcome sequence. They still haven't bought. Find a postal address for that person and trigger something at the end of that welcome sequence to see if you can get them off the fence. Site Match is where we're actually identifying anonymous website visitors. So people are browsing your site anonymously, don't opt into your email list or purchase. Again, we can find postal addresses for about 30% of those folks, and then we can retarget them with a card. And then once you get into acquisition, we can do lookalike campaigns or find very specific attributes that we want to look for in a prospect. Like we just launched in Target. We're an organic meat jerky brand. So we want to find people who buy organic foods, meat jerky products, have an active, healthy lifestyle, and shop at Target 3 times a month. So we can do that. And that's where we actually also start using our cartalogs, which, again, your question about formats. Cartalogs is like our version of a catalog. It's like a large folded type piece that gives you a ton of real estate to show off your product, educate people around your product, show a larger assortment of your product, which is typically best practice for more acquisition campaigns. You need to like educate people about your brand, your value proposition, show off a larger assortment of your product. But typically with catalogs, it's like 6-month lead time, 6-figure investment just to get started. If product goes out of stock like the day before your catalog gets sent out, you're just out of luck. You have to find a source for paper. You have to go through all these hoops. With catalogs, it's just like flexibility of our postcards. We could have them designed and out in 3 days, from start to finish. No minimum, no lead time. You could split test them. You could create different assortments. You could swap something out on the fly. So really good tool for brands, particularly on the acquisition side, and it's cheaper than a catalog at the same time.
You've got split tests, you've got win back flows. It literally is Klaviyo for direct mail. Amazing. In terms of, I suppose, like obviously you've had a ton of brands go through the platform at this stage. Have you any kind of figures behind like how it's improved CAC or improved retention rates for businesses? Have you any kind of, is there any expected results that you can get from utilizing a platform like PostPilot?
Yeah, so typically, just to give you like very rough ranges, because it depends a lot on the audience, the offer, the product, just like any ad campaign. With retention type campaigns, brands are typically getting 5 to 10x ROAS. Often it's even higher, but that's like a good benchmark to sort of set for yourself. And one thing that we encourage brands to think about is it's not necessarily always about getting the highest ROAS. It's about scaling up profitably as much as you possibly can. So it's like, if we can get a 10x ROAS on people that haven't come back in 120 days, that's great. But that means we should go to people who haven't bought in 180 days or 365 days. And if we're still getting, a 2-3x ROAS at people who haven't bought in 2 or 3 years, that's fantastic. You should still be sending to those people. And we see that all the time. On the retargeting side, again, sort of setting a benchmark of like 2 to 5x. And on the acquisition side, most brands are looking for like a 1 to 2x ROAS on the acquisition side. Again, can it be higher? absolutely. Is it an expectation that we like to set out of the gate? No, it's like, cold acquisition, cold prospecting is going to be challenging in any channel. And so like, that's a good baseline to think about starting out. And yeah, we just continue to sort of optimize and refine from there.
Really, really interesting. That's super. Okay, perfect. Okay, I suppose we'll wrap with one final one. A lot of businesses we speak to, and I'm sure you're the same, come to you, and there's so much to focus on in e-commerce. I mean, if you're a founder today, you've got to focus on your supply chain, probably now more so than ever at the moment with everything that's going on. You've got to worry about rising CAC. You've got to worry about retention. You've got to worry about your staff. Is there any, in your experience over the last 25 years, is there any like 2 or 3 things that you think e-commerce owners really need to get clear on in 2024 and beyond in order to kind of scale that business profitably?
Yeah, good question. I mean, I think to your point, too often brands do spend, or marketers do spread themselves too thin and sort of go after too many things and lose focus. And I think doing the basics really well is still really important. So, a life cycle marketing program, like ensure that you are really dialed in with reaching the customers with the right message at the right time and doing that across multiple channels. But again, doing it like just focusing on like the core of a very strong program is something that people often sort of neglect. Like they do the very basics. Okay, we have a win back campaign and we have an abandoned cart campaign. We just sort of leave it at that. Like getting that really dialed in, a proper welcome sequence with discount ladders and all those kinds of things is really important. And then again, understanding unit economics and understanding your OpEx. Like really take a look at what is driving costs in the business, understanding contribution margin. I don't want to go super weeds on like definitions around this stuff, but understanding like what true contribution margin is in your business and what are the drivers that are of your costs and contribution margin, and really starting to optimize them. Like one thing that we've done at some of the companies that we've run from on turnarounds is like zero-based budgeting, literally in some cases like cutting everyone's credit card off and saying if they really need a tool, they'll come to us and that's fine. We'll turn it back on. But like it can be amazing how when you like just shut things off, all of a sudden there's a million things that go away and nobody even notices. So like I think on the marketing side and growth side, having that program really dialed in, on the cost side, really understanding the drivers of contribution margin and OpEx in your business and constantly driving costs down versus always trying to think, how do I increase prices to grow top line or even spend more on acquisition, because your marginal cost of acquisition tends to get worse over time. So if you can cut costs out, that's just as good to get profits as it is to sell more stuff.
You're speaking my language, Michael. Very much so. I mean, I just think it's such an important point. Like often we plug businesses into StoreHero, and the difference is that they might be blaming their marketing agency or saying their marketing efficiency just isn't there. And how can we scale a business at this? And when you really plug in the system, you can see you're actually generating really strong contribution margin. What's actually killing your business is not your ads. It's this huge OpEx line that you've got. And the best marketing agency in the world is not going to fix this. And I think so many businesses actually have way more room to cut OpEx than they actually think they do. Just from the last 12 months, I've been astonished at some of the stuff that we've kind of come across. So I think that's just such an important point there. And like just to really hammer home the point, like $1 in revenue is not $1 in profit, but $1 saved in OpEx does go directly to your bottom line. And that's often something people kind of just don't think about. As probably silly as that sounds, I just see it time and time again.
You're absolutely right. Totally.
Perfect, Michael. So we're going to wrap. If people are to find you, where can they get in touch?
Twitter, LinkedIn, find me, Michael Epstein, and email me, michael@postpilot.com. Feel free to reach out anytime. I love talking to marketers and brand owners.
Brilliant, brilliant, brilliant. Listen, Michael, thank you very, very much for coming on. Really, really appreciate your time and really looking forward to getting this one out.
Thanks, Thomas.
See you, Michael.
Appreciate it.